Hi, I'm Steve Van Metre. It's Monday night, and we're live to discuss stocks. Are they in a bear market? Bull market? No, they're in a bear market. I'm going to give you a number of ways that you can tell a bull market from a bear market. Kimberly, thanks for joining us tonight. Glad you could be with us. So in a bull market, stocks will trade over something called their 200-day moving average. And we look back over the last 200 days. David, thanks for joining us. Over the last 200 days, you want stocks to trade above that line. In a bear market, they tend to trade below that line. So that's what we're seeing right now. You can also see globally industrial production start to head down, and we're seeing that. And part of the reason we're seeing that is due to the deceleration of the money supply, primarily due to central bank tightening. And of course, there's another signal when you start seeing central banks tighten. So you've got the Fed. The European Central Bank is now backing off their tightening. They're going neutral, which for them is dangerous because at the end of December, they said we're going to neutral. But in November, you've got Germany, Italy, and France all seeing their industrial production contract. That's very recessionary. The Bank of Japan, well, they're off in their own world. But we're also seeing Bank of China, which is just injecting some liquidity tonight. They're even tightening. So when you see all those things, but there's a really good litmus test a lot of people don't think about. And mainly we don't think about it because bull markets now in the modern day of central bank manipulation run about 8 years. And we're currently in year 10, well beyond the normal for what we see in bull markets. So in a bull market, when you have a correction, prices go down. Right? I mean, they'll go down for maybe a month or two, and then they'll spring right back up. That's a bull market correction. Now, when we transition into a bear market, well, people think the same thing happens, and it's the opposite. So when we transition into a bear market, people look for these corrections, and they go buy, 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 because they're thinking we're still in a bull market. And then they get caught off guard. And you can essentially just take this whole picture and flip it upside down, because when you're in a bear market, corrections go up, not down. They go up. That's where people get confused. So that's why we're in a bear market, because we're seeing corrections to the upside, not the downside. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre in personal capacity. The information expressed in this video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Advisory service offered by Atlas Financial Advisors Inc., a registered investment advisory firm. All right, so let's get retooled here. Because what I want to show you is just kind of look at some charts. I don't have quite as much tonight for you, but I do want to look at some charts, because when I got home, I was looking at this bear market, and what you see in terms of volume, and we're going to look at that, is in bear markets, when you see a correction, or when you see prices fall and a correction begin to the upside, you see volume high, and then volume starts to taper off as prices continue to rise. And so I'm watching this today after Friday thinking, okay, peak's in, things are going to roll over and start to go down. And I get home, and there was more done in the last hour between 5 and 6 p.m. Pacific than there was done all day in the market. I'm like, wonder what's going on. So instinctively, I pull up Twitter, because if there's something going on, someone financial world Twitter will post it. And sure enough, China is stepping on the monetary gas, of course. All right, so let's take a look at the S&P 500. Now we're looking at 1, 2, 3, 4, 5, and a partial here is the overnight trading. So we're looking at the futures of the S&P 500. You got a peak, a second peak, a third peak, a fourth peak. And you can see it's trying to form a fifth peak. And what's interesting is look at these candlesticks here. You see prices are trading up, and then they're being pushed back down, up and being pushed back down, up and being pushed back down, up, push back down, up, push back down. So what you're seeing is resistance. You're seeing sellers right here around 25, 95, 96, 97, kind of matching the peak here, here, here. And we'll zoom back out just a touch, see if we can get that last peak. And so you can see the sellers are pretty dominant right in here. Because when we zoom back out, let's go to the 1-year chart, which isn't going to look right there. But here we go with my support and resistance lines. We've got this 2600 has been a strong area of resistance, and it looks to be holding. You can see it kind of is going up and rolling back over. Well, tonight is kind of trying to nudge higher. But the bears are pretty consistently holding this line, and they're not having to put a lot of effort into it, because when we look at volume, and let's go look at the exchange traded fund, because you can't buy the index outright. You have to buy it through an exchange traded fund, mutual fund, or something like that. And here, look at the volume. So we have price came down toward the end of December, and all of a sudden volume perked up, the Cayenne bars, and price started to rise. But look at this, volume is falling down, and price is rising, starting to roll over. And if we look at volume, it's really low. I mean, today we traded 71 million shares. That's pretty low. And if we zoom out over the last 2 years, you can get an idea. It's pretty low. I mean, there's been lower points, but overall, it's not a lot of activity. So why does that matter? Well, that's a good question, because when you get these bear market rallies, the idea is the bulls are saying, come on, bid prices up, bring it in, buy. And so you get this surge of money coming in, right? That's that first move. And then the next day, the bulls are excited, hey, let's do it again, and boom. But there's less money, that's less volume, so less demand. Third day, bam, we're going to come at it again, even less volume. So as price does continue to rise, but the amount of buying power falls off. So what's happening now is the bears know we're in a bear market. And so their idea is we're going to take as much money from the bulls as we can. We got to let them think that they're winning. And they don't have to let them think too long, because the idea is as soon as the bulls run out of buying power, it's very obvious in the volume. And so when you have a market that's not being as manipulated by the central banks as they have been over the last, say, 10 years, you start to actually see things are starting to function the way they're supposed to. And volume is one of them. So when we look and we see this tapering of volume and this rollover in price, it starts to make sense. This is a bull market rally, because in a bear market, this is a bear market rally, because in a bull market, you get volume that starts and goes higher. It rises, so it shows demand. So it would be like if a store said, hey, maybe a local car dealership said, hey, we have a special and we're half off. And all of a sudden people flood down there. And as the word gets around that they're clearing out their inventory, more and more and more people come. In fact, during the housing boom, I went to a home auction. Oh, this is great. I'll get this house for a steal. I mean, it was way undervalued. The auction price was like $100,000. It was easily a $250,000 home. And I thought, oh, this is great. I've seen this on TV. I'll go. No one will show up. Literally, there was no parking. I mean, this place was so packed front to back, you couldn't even move. And that's what you see in bull markets. You don't see that in bear market rallies. You see just the opposite. All right, so let's look at some other charts. Let's take a look at the Nasdaq. If we see something similar in the Nasdaq, we do. Price is rallying up, hitting almost at the 50-day moving average and rolling over. Looking at the Dow, just got right around this area of resistance, kind of perked its nose over and starting to roll back over. Look at the Russell 2000, small caps, came right up to resistance, right up to its 50-day moving average, and is rolling over. Again, all the things we would want to see. Even volatility is hitting its 50-day moving average and looking like it's trying to bounce. The volatility ETF, which you should never, ever trade. If I have never mentioned that before and you haven't heard me say that, do never trade this. I thought it was going to find support right here, this first bar that I've gotten. But no, it looks like it's finding support at this lower bar. So we'll be interested to see if this holds, because if it does, again, it tells us volatility is headed much higher. As far as 10-year Treasury yields and after hours trading due to China, these are up a little bit, somewhere right around, say, 2.72%, not a big deal. Heavy resistance coming right in here. And the big thing about the bond market right now is the big banks are buying huge amounts of bonds. Huge. I mean, they have never bought as many bonds ever that they did in December 2018, and already as of last week, they're at 22 billion first week January. So, I tell you who's propping the bond market up. It's the big banks, and there are a lot of short sellers who are going to get crushed at some point. Looking at the 30-year, this is where the short sellers are really focusing their attention on, trying to really drive 30-year yields up. Still resistance kind of right into here. Let's take a look at the energy sector. I believe this is going to roll over and head down, and you can see it didn't even get to its 50-day moving average. But the better way to look at the energy sector is oil. And look at that, bam, hit the 50-day moving average. Remember when I said if it's in a downward sloping 50-day, it generally doesn't break over that. It hits it and it gets rejected. It tells us oil is likely to head lower even after this China stimulus thing gets passed through the news in the next day or two. Let's see what else we've got. Let's take a look at the gold miners. Another good example. Look at this. You get this rising volume. Now this looks like what you want to see in a bullish trend. Rising volume, rising price. That's what you want to see. But look what happened. Sellers came in right here, this big spike in volume, and then all of a sudden volume's tapered off and price is still rallying a little bit, and now it's rolling over again. Demand is going away. Tells us again the miners are going to roll over, head back down. I think they'll confirm somewhere right around in here. And that should be a good spot to start to take an entry point. Looking at silver doesn't give us enough volume to really tell us anything there. Oil producing stocks didn't get up to the 50-day, and they're starting to show signs of rolling over. I think they're going to come back down as well. Let's see what else we've got. Let's take a look at the 7 to 10-year Treasury bonds. Beautiful, found support right at the lower end of this channel. Obviously, in after-hours trading, this is going to be down a little bit, but it's really, if the bulls can just get this to break above here, they're going to get some of these short sellers out. But look at where the short sellers came in is right up in here, right? And look what happened. The volume's tapering off because they're just running out of buying power. And that is pretty normal in a decelerating money supply. See, when the money supply is growing real fast, there's plenty of money to dump into things. But when it's not, you have to kind of pick and choose where you're going to spend. It's no different than budgeting and either having a pay cut or having your hard expenses rise. You've got to make, cuts somewhere, or you just can't put as much at work. And that's what we're seeing here in this bear market rally. Looking at the long bond, finding support at this I kind of moved some lines around a little bit. There seems to be a lot of support and resistance right down here in the center channel, trying to find something here. If it does, again, it can break out above that, and that would be pretty big for the bond market. In fact, we can zoom out, and you can see that once it gets kind of over here, this noise starts to get out of the way, and it's got some room to run. And on the 7 to 10 years, it's got a lot of room to run upwards. And if the 7 to 10 year bonds move higher, it will bring the long bond with it. There's no question about that. Let's see what else we've got. I don't want to pick on PG&E. I just want to point out that this is very interesting because you don't see this happen every day. So PG&E is largely expected to file bankruptcy soon. The CEO resigned today. And from Friday, the stock was trading here. It closed out at $17.59. And today, minus 52.36% later, it closed at $8.38, traded 127 million shares a day. So what you're seeing here is people that are getting out of this because they know the ship is sinking, and you're seeing opportunists come in because they don't think the ship is sinking. But in the reality is PG&E's got some big problems potentially coming. The question is, will the state bail them out? And if the state bails them out, then the people speculating are going to win. If the state doesn't, well, those of us in California, like myself, are going to see their utility rates go way, way higher. So just because it's a utility company and you might feel safe, it doesn't mean much. Diana, thanks for joining us tonight. I hope you enjoy our live. And so unless we have any questions, and I've come to the conclusion that the questions don't always come through where I can see them. So if you do have a question and I don't get to it or see it, just post it in the the post later, and I will definitely get back to you. So I want to appreciate you joining us. We'll be back Wednesday, and hopefully we'll have some more interesting stuff to look at. Instead of a market just rolling over at the top, maybe we'll actually see it come down, and that'll be interesting because, well, I'm sure it'll be. All right, I'm Steve Van Metre.